If you've spent any amount of time researching the infinite banking concept online, you've probably heard some pretty strong opinions about it. You might have heard, you're simply borrowing your own money. Whole life is a terrible investment. Why would you pay interest on your own money? Lots of different, strong opinions from that standpoint. The thing is most of these opinions are really coming from a point of misunderstanding about what the infinite banking concept is and or isn't. And if you've spent any time watching the other videos in this series, we've been able to kind of identify a lot of these different topics throughout in some way, shape, or form. But I think the important thing is understanding what the infinite banking concept is all about. And that is it's a process to control the flow of money through your hands, meaning the banking function, over the course of your lifetime, and recoup those financing costs that would normally be lost to a third party, to a bank, or simply paying in cash. In our 8th installment of the Infinite Banking Beginners series, we're going to talk through some of the biggest misconceptions that exist about the infinite banking concept. So let's jump into them. So the first one, infinite banking is an investment, perhaps. Some people look at it as an investment. And the fact of the matter is it's simply not. The infinite banking concept is a process, not a product, not a tool, not an account. It is designed for you to have a system of control over your money. That is really and fundamentally what the infinite banking concept is all about. It's having a system where your income can flow in, you have ownership and control over it, and you benefit from the cost of those flows of money into and out of your hands over the course of your lifetime. And all too often, most people are simply misconstruing that with a product or the product that we use to provide the access to that capital over time, or the tool in that situation. And they tend to look at it as an investment, when in reality, it has nothing to do with that at all. It is a process, and it simply uses a tool to do that. And I've talked about this in other videos, but that's our first one. It's simply not an investment. It is a process. So the second one is kind of funny because, we've certainly heard a lot of talking heads talk about this, but you're borrowing your own money. I know Dave Ramsey has mentioned that before, and he couldn't be further from the truth. But the reality is you're not borrowing your own money at all. You're simply leveraging the cash value that's in a dividend-paying whole life insurance contract to access capital to go put it to use in the way that you see fit. And it gives you a lot of systematic control because you have guaranteed contractual rights to do just that, to go to access that capital and go do all the things that you would normally do. I think this is a great point to call out of having your money at work in multiple places, doing multiple things for you at one time. And when we think about dividend paying whole life insurance contracts through mutual providers, when the money goes in, it's now being given multiple jobs, in that it's creating death benefit, it's growing on a contractually guaranteed basis, that profitability of the company is going to come back to us in the form of dividends. So there's multiple things going on from that $1 that went into that contract. And then from there, you're able to then access that cash value, like we talked about, via a policy loan, and you can go put that money to use someplace else. So it again is generating more dollars for your system in some way, shape, or form. And how you want to use that is really up to you. That's the whole point of it being infinite in many respects. So the next one that ties in really well, and this one's kind of interesting to me too, just because of how people use it, but really miss the fundamental aspects of money, is why would I pay interest to access my own money? Well, let's be real. Everything in life is financed. You either give up interest that could have been earned on your cash, or you are going to pay third-party interest to someone else. So in this case, and I think the biggest argument that most people make is, well, I could just pay cash. Yes, you can. And you would be right to say that paying cash feels good. The problem is that you're still missing out on what that cash could have purchased for you over the course of your lifetime. I've done other videos on that topic and talked about it before, but that it can have a significant amount of impact for you over the course of your lifetime. If you're giving up, say, $20,000 a year because in cash for different expenses, what would that 20,000 do for you even at 5% interest, even in a given year or 10 years or 20 years? That's the thing to start thinking about in this situation. And that's what the infinite banking concept helps us to solve. If that $20,000 goes into a policy, it's now going to be earning forever for the life of the contract at a contractually guaranteed rate and earning dividends and giving you access to the capital. Now, when you access that capital, and this is where the thought process comes in as well, I have to pay interest on that. Yes, you do. However, if you were going to buy something anyway and have to save up for it anyway, and you're repaying that policy loan, that repayment structure is in your favor. Every time you make a repayment to a policy loan, it goes directly back to principal. And in that situation, the amount of interest that a person actually pays is significantly less than what it would be if you were to actually go lend and take a loan from a third party. So there are very significant advantages to you in doing so. Not only that, if you do pay the interest and it's going into a company that you now directly are part owner in, don't you think that that helps benefit the company in terms of profitability? Well, it does. Of course it does. Well, that profitability, as it continues to be more profitable, comes back to you in the form of dividends within the policy. So you may not recoup all of that interest per se, but it's certainly, if you're going to pay interest anywhere, wouldn't you pay it to yourself or to a company that you partially own? That's really the whole crux of the concept in this particular situation. And so much of it is lost on assuming that there is no cost to cash. And there certainly is. And that's really the fundamental point behind Nelson's key principle that everything in life is financed. So enough on this one. Let's move to the next one. So this one is always funny to me in that people say, well, whole life has a terrible return, or whole life's a terrible place to put money. You know what? Traditional whole life insurance that has a very fixed death benefit and does not grow, and it only, through a stock company or something like that, and the death benefit never changes, never grows. Yeah, that's probably not a great place to put money. However, what we're talking about in the course of the infinite banking concept is utilizing specific type of whole life insurance. By somebody saying that whole life is a terrible place to put money, that's like saying, well, all cars are bad. When in reality, some cars are very good. Some cars do great. Other cars maybe aren't so good. Well, dividend paying whole life insurance through mutual provider is uniquely different. And the death benefit in that first year, that's the smallest it's ever going to be. That death benefit and that cash value is going to continue to grow over time by contract through guarantees. And that is fundamentally different than anything else that's out there, at least in terms of life insurance. Now, the other thing is why are we comparing an investment to a protection product? Right? Like that shouldn't be, we shouldn't be saying, let me compare this apple to this orange and then tell you why this apple's so bad. Like that doesn't make any fundamental sense, does it? I mean, for real, I'm asking that question. And that's something that we have to be thinking about as we think about this process. We are using a specific tool for a specific process. We are not looking to do an investment. What we can do with the cash value that we accumulate in the policy, we can leverage that cash value to go purchase investments and generate significant levels of return. That's still very much possible. The point is right now, you're probably putting all of your money into somebody else's bank. And who's benefiting from that? Someone else. You're certainly not, because it's not in your bank. And that's what we're doing with the infinite banking concept. We are creating a banking system where you now are in control of all 5 parts of the banking process. Not only are you the depositor, you're also the borrower, you're also the lender, you're also the banker and the bank owner. In the conventional form of things, if you don't control the banking process, you are the depositor and you are the borrower, and that's it. You don't get any benefit from those other core positions within the banking process. And lastly, on this point, talking about that whole life has a terrible rate of return or whole life's a bad place to put money. If you're comparing the whole life to the S&P 500 or you're comparing it to some other type of an investment, you've already missed the whole point of the concept. You're completely misunderstanding what we're doing with the infinite banking concept, and that's controlling the banking function. So misconception number 5 that we have here is IBC is just about whole life insurance. Well, that couldn't be further from the truth, because just because somebody has a whole life policy does not mean they are practicing the infinite banking concept. If you simply have a whole life insurance policy and it's there explicitly for death benefit protection, then that's what it's for. That's all it's being used for. What Nelson was talking about when he understood this concept and developed it over the course of roughly 20 years, he realized that dividend paying whole life insurance through a mutual provider actually acts so much more like a banking system, and then just has a death benefit as a cherry on top. It's all about how it's used. So again, let's use the concept of the automobile. If I have a truck and all I do is drive it around town, am I really getting the full use out of that truck? Of course not. The whole point of it is to use it for its intended purpose. And it's to haul things with. It's to, I could use it as part of a business of hauling things around for other people, like really basic concepts on that front. So what we're talking about is by using the dividend paying whole life insurance contract to its fullest extent, with all of the contractual obligations or opportunities that are afforded to us as owners, we actually can control the banking function in our lives and in turn benefit and grow the policy as well, along with using it for investments, using it to take over all these different aspects of financing over the course of our lifetimes and profit from it. And that's really fundamentally what we're doing. I think more importantly on this one, infinite banking isn't something you buy, and whole life insurance, as it's applied within the infinite banking concept, isn't a product you just buy and it does something. It's what you do. It is a lifestyle. The infinite banking concept is a lifestyle change of how you operate and how you interact with money. And that's what we're looking at. That's what we're doing with this concept. So the next one here that I've heard from many people a few times is that you need to be wealthy in order to do the infinite banking concept. And that just couldn't be further from the truth. Should a person be in a position where they have reasonable cash flows, meaning that they have positive net cash flow each and every month and they're not going into debt every month? Well, yeah, that would be an ideal point to start from. Discipline is a really important thing to have. And if a person can demonstrate the discipline, then the infinite banking concept really can work for most anyone. It might not be for everyone. And the reason I say that is it does require discipline. It does require working with a coach like myself or others in the Nelson Nash Institute. It takes time to develop the education and the understanding of how to properly do this. And again, as Nelson said, it is ridiculously simple. It is not hard. All we're doing is simply changing where our money flows first, and then how we finance the things of life that we would normally buy anyway, and then where those repayments flow to. That's it. Like, it isn't that hard. If you're already someone who's a saver and you save up and then purchase things, you're likely a perfect candidate for the infinite banking concept because you've understood the basics of capitalizing before consuming. And the thing is like, if you're doing that today, you're saving up and then purchasing, when you do that, that money's gone forever. With the infinite banking concept, it's a way to retain that money forever. And you're just going about it a little bit different way. And you're benefiting from it for the rest of your lifetime. And your future generations are going to benefit from it as well. Whether that's through the death benefit or from the education and things that you're going to give them and pass along and grow your legacy. It ultimately is about being intentional and being focused and disciplined about where money flows in your life and benefiting from it over the course of your lifetime through proper use or through the use of a tool that we use within the concept. Again, you don't have to be wealthy. When we got started, we were able to do a lot with a relatively small amount of premium that was being paid. So Does that mean that everybody needs to start small? No. I mean, you can start very large as well, but over time, the size of your system is going to naturally grow as you learn to properly implement the process, and you're going to see all the different ways in which you could be benefiting from taking advantage and being in charge of those cash flows in your life. So another misconception that's often out there is that policy loans are free money and you don't have to repay them. Now, this couldn't be further from the truth. Policy loans do incur interest at some level. How that works might be a little different than a traditional loan. Regardless, it's not so much it's free money. That's a silly concept here, and a really silly thing for anybody to be thinking about. You're missing the concept of capital. There's always a cost to capital, and that's a super important thing to keep in mind. You are collateralizing your cash value in a dividend-paying whole life insurance contract. So that being stated, there is an amount that has to be repaid over time. Now, how you do that could be very different. Let's say I'm in real estate and I'm using my policy loans as for rehabbing properties that I'm purchasing and then turning around and flipping them. Well, if I take out a policy loan for $75,000 to rehab this home, and I know that I'm going to sell the home within 18 months, like let's say it takes a little longer than normal, I might not make any repayments on that $75,000 because I know I'm going to have an influx of capital at some point when that home sells, and then wipe out the policy loan at that time, freeing up the $75,000 plus any additional premiums I paid. And I will probably have even more available to me at that later point in time. Now, again, using that real estate example, I might instead, if I know it's going to be 18 months, I might just make interest only payments over that time, just to ensure that I am keeping ahead on that policy loan and it doesn't get out of hand for any given reason. Not that it would in that situation, but again, just something to think about. I think most importantly in this area is you're the banker. You're the one who's in control. And an honest banker, a good banker, is going to make some sort of repayment or have a plan, have a dedicated repayment schedule for a loan. A loan in your system needs to be viewed differently. It needs to be viewed as an asset. So if I'm an honest banker, well, then I'm going to ensure that I repay that asset because that capital is going to come back and I'll be able to use it again and hopefully go make another profit on the next deal. So probably one of the, I would say, less likely misconceptions that I've heard is that infinite banking is a tax loophole. And that couldn't be further from the truth either. It is definitely not a tax loophole. Dividend paying whole life insurance does have some great tax advantages, meaning that you have tax deferred growth, and ultimately that can become tax-free growth so long as a person never, withdraws from that policy over and above the cost basis, so long as they do not turn the policy into a MEC of some sort, or in the event that they would ever surrender the policy after it has generated significant levels of growth. So long as somebody is not doing those things, which as an NNI practitioner, that's one of the things we definitely coach people on and help people to understand. It is making sure that you know the right decisions to make and do with this great asset that you have at your fingertips. It helps make sure that those negative situations don't happen. But that being said, under current law, Section 7702 of the Internal Revenue Code, it does give a lot of advantages. Life insurance has advantages from a tax standpoint. Like I said before, it's the tax deferred growth. The death benefit passes on tax-free to your next generation. So there's no tax that's no income tax due on that amount. So that's where the advantages come from. And if somebody is placing large amounts of capital into the contract through the form of premium, well, if I know those rules and I know those stipulations, well, my money is going to grow on a contractually guaranteed basis in a tax deferred manner. And we have to say tax deferred to stay compliant, but in a tax deferred manner. And it is going to pass on tax free to my next generations. And that includes all that dividend growth and all those things along the way too. Again, definitely not a tax loophole. It simply has a lot of great tax advantages. And again, that's the tool that we use for the infinite banking concept. The infinite banking concept, again, is a process, not a product. So it's important to keep that in mind. So in wrapping this one up today, IBC, or the infinite banking concept, isn't about eliminating the cost of finance. It's not about free money. It's not about all these things we've talked about. Instead, it's about changing our relationship in the financing equation. We become the ones who are in charge. We benefit from the process of banking. And that's really what it's all about. And it's not about a product. It's not about an investment. It's not any of those things. It is about how we are in control and putting ourselves in control of that banking process. A lot of these misconceptions that we've talked about, I have actually touched on before in some other videos, and I can place those here so that you have access to them. Some of the myths, some of the misconceptions. It's important to understand that our understanding about anything is critically important. When we know what's going on, we'll know what to do. If you found this video valuable today, please like and subscribe. We're going to continue on in this video series. In the next video, we are going to be talking through why thinking long-term is really important and why long-range thinking is important to us in our day-to-day life. And if we're thinking in the long run, we're likely to see higher levels of success. So thanks for watching today. We'll talk to you again soon.